We want to bring in Gabriela Santos. She is Chief Market Strategist for the Americas at JPMorgan Asset Management. And Gabriela, I just want you to help us understand what's happening this morning. It's been a very interesting week, a lot of things happening since the Fed meeting, and the market's really getting roiled a bit. We look at the futures down pretty significantly this morning. I know it's a triple witching day, but how much of this is what Jay Powell had to say at the Fed meeting the other day? How much of this is what's happening in Washington and the uncertainty there? How much of this is triple witching? And has the overall view of the market actually changed this past week?
Becky, I think it's a combination of all of those three things. The first, on the Fed itself, high for longer was not unexpected. But the reason why the shift in the economic forecast brought back inflation and signaled to investors that it's high for longer, but perhaps for the wrong reason.
Higher for longer for the wrong reason. And by the way, you may not be getting any more cuts. That was the message I got.
And the market pricing and probabilities, thinking of, well, maybe I need to reduce my expectations of cuts, or maybe even at some point next year, we could bring back the conversation about hikes. And to us, that was not really justified. We had actually been expecting a higher upgrade to economic forecast that barely budged for next year, only moved up 10 basis points. We think it's much more about the economic resilience versus the inflation forecast, which moved up 30 basis points for next year and 20 basis points the year after, which to us doesn't seem justified by the data, seems more, as Chair Powell acknowledged, a conversation about tariffs, which brings us to the second big reason, which is really the policy fog on the other part of D.C. I think the market had priced in a lot of the good stuff from the next administration and now has swung the pendulum to the other side about focusing on some of the less favorable aspects from an equity perspective. And it just kind of keeps swinging back and forth until we get to a good understanding of the details. And then lastly, frankly, I think it's just, the end of the year, we had such a strong rally in the market.
Right, people may be selling.
It's just a little bit of fatigue. And especially, right, from mid-September up until the beginning of December, we had perhaps a little bit too much of an increase in certain deep, cyclical, small-cap parts of the market that perhaps became a little overdone.
So has your view of the market changed this week?
Frankly, no. We called our 2025 outlook out of the cyclical storm and into the policy fog. Out of the cyclical storm, an acknowledgement that really overlying the economy is pretty good. It's just kind of normalizing its growth rate and its patterns. But especially in the first half of the year, we're coming into a policy fog in D.C. and where we need to kind of round out our decimal points here in terms of growth, inflation, and rates expectations. Overall, we're still feeling bullish about equities, about corporate credit. It's just that I think the market in the very short term tends to think about absolutes, and there's a lot more nuance and uncertainty.
So what do you tell people to do? I mean, we're not far from all-time highs, really, if you're looking at it. But what do you tell people to do here? Do you buy? Do you wait for a bigger dip?
So I think it's really what you buy. So if we look at investor portfolios, I do think there's been a very strong, of course, rally in the market for 2 years. Portfolios to begin with might have gotten tilted much more to the equity side. So for some investors, don't need to do anything. It's much more about looking at the stealth unbalancing beneath the surface, right? A lot of tilt to growth. And then recently, investors dipping their toes in deep cyclical, deep value, small cap kind of stocks,
which is deep value. Give us an example of that. I know you don't like to go names, but help us.
So I think there was an expectation that all of the good stuff of policy would re-accelerate growth, re-accelerate earnings, and all of a sudden you could have the kind of high beta stocks that do well when you're just coming out of a recession, re-accelerating do well, which is not what we're describing. We're really describing an improvement in earnings, but there was slower economy.
When we were looking after the Fed's reaction yesterday, I guess Wednesday, if you looked at the small cap stocks, the Russell 2000, they were off by 4.4%, that index. So it was off by even more on the expectation that, okay, if we're not going to lower rates anymore, those lower rates that small businesses really need are never going to make it to them. It's the big businesses that can continue to operate in this environment. Is that still the case? Do you agree with that?
I think large cap, small cap is the perfect example of this. So it's that rates aren't going down as much, but also that policy isn't going to be so supportive that you get a massive growth in earnings reacceleration.
So do you like bigger stocks over smaller stocks?
In the middle.
Mid-cap.
Mid-cap. So I think that's the nuance of the conversation, is that in the short term, it can be very binary and very extreme. Either it's large or it's small. But actually, there's a lot more nuance, and there's a middle ground. And that example of mid-caps is a good way to capture that.
So we were talking to someone the other day who mentioned that if you have big gains and you want to sell a stock, you might do that at the beginning of the year, because then you can wait another year to pay the taxes, the capital gains on that. That's a suggestion that you could see a lot more chaos come January. You agree with that? You believe in something like that? Because if I'm seeing this and I'm thinking that could happen in January, I might wait a couple of weeks.
And that's always the trick about waiting, right? I mean, people could have waited from the first all-time high we hit earlier this year up until the 57. So take that with a grain of salt. But yes, we do see a lot of focus on the tax conversation from our clients. And I think for some, it's still that conversation about either end of year, beginning of year. But really, the bigger shift we've seen in asset management is much more active, frequent tax loss harvesting strategies that might limit some of these moves earlier in the year. But of course, taxes are an important consideration. And a lot of portfolios had gotten very tilted, and there's work to do to just bring things a little bit more in balance between the extremes here.